Is the success rate sustainable? Let's take a look. We have heavily tested the strategy of selling 45-day, one standard deviation SPY strangles and have found the success rate about 77%. Now, somebody wrote in the last email, they said, is that 68% theoretical number correct? And we said, well, for undefined risk, the number is going to be higher because you have defined profitability. For defined risk, or when you're long the underlying, it's going to be lower because you have unlimited profitability. That's how this business works. Everything is, the risk return graph is perfectly symmetrical. So that's why it looks like that. The 77% is well above the 68% theoretical number. And this rate is well above the threshold, like they're saying. How do you get to 68? Well, you take your 216, one standard deviation is 16 deltas on each side, multiplied by 2. That's 32, subtract from 100 to 68. Do success rates for the same strategies differ greatly across different stocks? What do you think about that? Do success rates for the same strategies differ much across different stocks?
I gotta say yes, and
answer is of course no.
Yeah, I know, but I'm gonna tell you why I gotta say yes, because we do studies where a strategy works in a time period better or worse than other stocks. Like if you were looking at just naked puts in, say, well, gold would be a bad example, like nat gas versus gold, two different commodities. Gold had a nice upward move.
But we're talking about random results in different, the answer is it can't. They have to all be the same.
Well, the probability of success is going to be the probability of success, whatever that is.
So to determine the answer to that question, we examined multiple stocks from different sectors, including telephones, Pfizer, Apple, Microsoft, Tesla, Baba, First Solar, Exxon, JP Morgan, and UPS. We compared the success rates of 16 and 30 delta strangles with both with and without management at 21 DTE. Theoretically, according to the Tasty platform, the win rates of the 16 and 30 delta strangles should be around 68 and 55% respectively. In your head, remember that 68 and 55. So for 16 delta strangles, almost all the stocks tested have a much higher success rate than theoretically suggested. Apple is the only stock with a lower success rate. Overall, the average success rate of these stocks is consistent with that of the SPY, which is what you would expect. The SPY is 77, and when you look at all the other stocks average, it was 76. That difference is statistically insignificant, but you can see the actual results up here. If the SPY is 77 and Microsoft 78 and Bob is 78 and First Solar 78, JP Morgan 78, Tesla 74. You can see it's pretty damn close.
Also answers the question from that confirm and send that we had.
Exactly. Yep. Just from 5 minutes ago.
Hmm.
When you jump up to 30 delta strangles, for the 30 delta strangles, the success rates are more consistent compared to those of the 16 delta strangles and higher than the expected 55%. So the average success rate is identical to the SPYs. So the SPYs have a theoretical of 55. They have an actual of 66. All these stocks together have an actual of 66. And so when you look at this, you're like, wow, that's amazing. See, we've done so many studies over the years on how accurate option pricing is and how good these high frequency firms are at making markets, and dollars at risk almost comes out the same regardless of what you're trading. That doesn't mean that there's not some edge in one stock versus another stock because the IVR is higher, whatever it is. But over time, as everything normalizes, the 30 delta comes out to exactly what the 30 delta should be. The 16 delta comes out to exactly what the 16 delta should be. Okay, and dollars at risk are completely commoditized. They're normalized across the board. Let's go to the next slide. Existing positions at 21 DTE, what that does is it smooths out the results across all the stocks. So Apple's success rate, which was a little bit lower before, is significantly improved and in line with the other stocks when you manage early. Essentially, what does managing early do? It gets rid of the volatility of your portfolio, gets rid of that wild standard deviation, those swings in your portfolio.
And you just talking about it, you don't realize how important that really is to your overall trading. Because if you can have a smooth curve, whether it's smooth curve going higher, sideways, even a little bit lower, you can stay in the game. When you have swings like this, you don't make good decisions.
As you notice on the right-hand side at 21 DTE, the stocks themselves had a higher average success rate than the SPY did. Take more risk. If you manage early, you get paid a little bit more. Managing early here is the key. and this is the 16 delta slide. We found that when the 30 delta, the improvement is way more significant with larger deltas because you don't have those outlier drawdowns. So the success rate's equal to or greater than the hold to expiration approach in all 10 stocks. So even though the average is still at that 68, the numbers are really strong. Again, we don't sell a lot of 30 delta strands. We're in that kind of that 16 to 20 to 22 range.
Yep.
Managing early is the key here. Just manage that trade way earlier, take a lot of that risk off the table. Some of the takeaways: selling options in individual stocks can achieve relatively consistent success rates despite the sector differences. Dollars at risk normalized across the board. On average, the success rate is similar to that of the SPY, using individual stocks or SPY, it doesn't matter. And managing positions at 21 DT reduces the success rate volatility with more significant improvement observed in large delta strategies. So what happens is the more risk you take, the more improvement you see at that 21 DT, just in kind of flattening out your vol risk.